Okay, everyone, I am going to go ahead and get started. I want to be mindful of all of you all who showed up early, and thank you so much for joining tonight. I'm super excited to talk about this topic. Thinking I'm very intentional with everything that I do, especially choosing dates. It's December 20th, 2021. We're about to enter the winter solstice. And this is really a time of renewal, letting go, releasing, moving forward. And as we come to the end of the year, it's December 31st. And a lot of folks usually take this time to think about what do they want to do? What do they want to do differently? How do they want to improve for the new year? And of course, I have a topic about what we could look at when it comes to our finances. So again, thank you everyone for joining. This is definitely being recorded, so I will be sharing a copy of the presentation and the slides with you all tomorrow. Other folks will probably be joining as well. But if you stay to the end, I have a super surprise, a nice little surprise that I normally don't do for everyone who joins. So if you're able to stay to the end, I want to have this wrapped up in an hour. So just to give you an idea of how long we'll be here. As always, this is to be engaging, so feel free to type in questions as I go along. I will take questions at the end. I will stop the recording as well to take questions so that you can ask me directly. And of course, I always have tons of resources to share as well. So we will go ahead and get started. So just to introduce myself, for those of you who don't know me again, my name is Shantae Moore. I am the Director of Native American Financial Literacy Services, a certified financial educator and investment advisor representative, which is also known as a fiduciary. And I'm also a certified college consultant. But out of all these certifications and degrees, I just teach people how money works. And I pride myself on teaching these things in very practical ways, in ways that we probably have not been learned, in ways that we have not learned about money, but also in a way that we feel more empowered to do something about our finances. So quick disclaimer, I know it's a little hard to see the little letters, but all I'm basically saying is that everything that I'm talking about tonight is strictly educational. Even though I do have my own private financial planning practice, I don't want you to assume that anything that I'm sharing is any type of advice or as a sound source for anything legal, tax-wise. Yes, I'll go through some examples, but they're all hypothetical. And then most importantly, you will not learn everything tonight in our time together. I will actually be rushing through the first couple slides because it's more basic information. I like to get to the good stuff. So again, watch the recording and you'll get a copy of the presentation as well. So I want to just kind of take a step back about, why do I do what I do and why is it a need to have this conversation around financial literacy? It's a big term that has really became more popular, I would say really over the last year or so, about folks needing to become financial literate. And that's what my passion is just to teach people about money, because we often don't learn this stuff. We don't have these conversations in our day-to-day lives. We know statistically most North Americans cite money as their number one worry. When you really dig down and talk to folks about what's keeping them up at night, what are they stressing about? And especially the results of this ongoing pandemic, most people are worried about their money. They're worried about their finances. Some of the reasons being is that because they have a lot of debt and it's like they see no way out of it. They know that a lot of folks know that they're not saving enough. I put down here for retirement, but it could just be in general. They know that they're not putting money away for those emergencies that always seem to pop up. And then my belief is that unfortunately, a lot of folks are just really ignoring their money problems. It's like the big elephant in the room that they don't want to look at, they don't want to address until a financial disaster happens. And again, we've seen that until you lose your job, until the breadwinner unexpectedly passes away, that's when people turn an eye to their money and they're like, oh crap, we weren't prepared at all. So my goal in this presentation is that you walk away prepared. You're going to know exactly what you need to do for 2020. But, I also don't come sharing bad news without talking about what's the light at the end of the tunnel. I want people to understand that financial literacy isn't just working with a financial professional or just Googling things online. When you're financially literate, think of it, what does it mean to be literate? It means you know how to read. When you know how to read, you know how to navigate this world. You know how to look at contracts and read signs. The same thing when it comes to being financially literate. It literally means you know how money works. Because when you're financially literate, you know exactly how to make your money work for you, not against you. A lot of folks don't know how to make that money work for them. When you're financially literate, you can't be taken advantage of due to lack of financial knowledge. I know that I work in BIPOC communities and Black and Indigenous people of color communities. I specifically reach out to those communities nonstop because we're always, not only are we underrepresented in the financial industry, we're always being taken advantage of, unfortunately, because we don't have this information. But I would say the most important thing is that when you're financially literate, you are 1,000% confident, and when you make wise strategic decisions when it comes to your finances. Honestly, I see most folks, their financial decision process is thinking of something, crossing their fingers and hoping it works out. Like that's literally their process. No, I want you to be confident and wise and know that if I put my dollar here, this is what it's going to do for me. This is how it will serve me. And overall, when you're financially literate, you have the ability and the skills and knowledge to manage your financial resources effectively so that you can achieve financial stability. You know, when I was sharing about this webinar presentation, I said it doesn't matter what your income or budget is, you can still apply these things and principles that I'll be talking about tonight, because at the end of the day, you have the knowledge to manage your financial resources effectively. Unfortunately, a lot of folks are not managing their resources effectively. They're just throwing money against the wall and hoping it sticks. No, confident and wise. And then you have financial stability, because no matter what, I don't care if you lose your job, I don't care if the government makes a new law, your finances will not be dramatically affected. So before I get into the presentation, if you know me, I've been talking about this book for the last 2 years or so. It actually came out in October of 2019, called How Money Works, Stop Being a Sucker. I encourage you to request a copy of this book from me. If you don't have it, I think pretty much everybody on this webinar. Oh, there you go, Roman. Yeah, I was going to say, I think everybody on this webinar has their book. Yeah, and I send it out to everyone free because I want people to have this resource. I eat up all the costs and all the stamp. It takes $3.19 to send these books out, but I want people to have it because it's such an easy resource to learn these things that I'm talking about. So I'll actually share my contact information about how you can request a copy of that book with me. So let's get into the presentation. So again, I'm all about practicality. Feel free to take notes, and everything that I'm talking about on here, I can personally help you with, okay? So when I think of helping folks with their finances, I look at it from building a foundation and building it from the ground up. It's kind of like when you build a house, you don't start with the roof, you start with the foundation, right? So when it comes to your finances, the same way. There's 5 steps in building a solid financial foundation. That first step is having proper protection. So anytime I talk about the word protection, I'm actually talking about all things insurance. This could be life insurance, health insurance, disability income insurance. We get car insurance, home insurance. You know, we're required by law to get those insurances. Why aren't we required by law to get those other personal insurances that we so greatly need? So today's conversation, I'm actually going to really focus on having proper life insurance, because I tell folks, I don't care what your budget is. Let's say you have $100 per month. You should be budgeting to pay for some type of life insurance policy out of that $100. First and foremost, you need to have proper insurance coverage. Why? Why does it matter? Because no matter if you're single, married, anyone, if most 99% of the population needs insurance coverage, because we've seen it. I think we all have had those stories where somebody passed away unexpectedly and there was no money to take care of their final expenses. There was no money to pay off their debt. Families have lost homes because folks did not have proper life insurance. So when I talk to families about having protection, I'm like, look, I think most folks understand they need protection. And to be honest, I don't think it's just having anything through the workplace. I think you should have something that's not tied to your job, something that you own on your own, because we've seen it. You can leave jobs and then there goes your insurance. So with life insurance, you should have not only just a policy, but you should have a policy that has proper protection that will fully protect your family. I don't want you to have just enough money to pay for your funeral. I want you to start thinking about leaving a legacy. What am I actually leaving behind? And this is a method that I typically go through with a lot of my first time clients to help them figure out, well, how much life insurance should they get? Because you shouldn't just be pulling numbers out of a sky. There should be a way that you actually calculate how much insurance do you need. So this method is called the DIME method. The D stands for debt, I for income, M for mortgage, and E for education. So first of all, if you have any debt, you should know that just because you pass away, that debt does not disappear. It's not like the credit card companies will say, oh man, Shantae's gone. We're just going to cancel this debt. No, if a creditor finds out that you passed away, you know what they can do? They can actually file a claim against your estate and try to get paid the balances that you're owed. You might owe $10,000 on a credit card, and here comes American Express saying, "Oh, Chantel, you have $10,000 in your bank account." They could petition a judge to say, "We need to be paid first before you pay that money out to her family." It's so important. Folks don't really understand that. Most instances, yes, they'll probably go away, but I've seen creditors come after spouses. They've come after family members to try and collect the debt that was owed and try to get money out of that person's estate. Now, most people die without having much money, so they really couldn't get to it, but it happens. So I calculate, look, if you have any form of debt, car notes, student loans, personal loans, credit cards, let's calculate into your life insurance benefit amount enough to pay off that debt so your family won't be burdened by any creditors. I is for income. We typically recommend for you to replace 10 times your annual income. If you have anybody, any dependents, any children, anyone who significantly depends on your income for their well-being. So if your income is significant to any person, you should try to replace your income to those individuals or to your family. In this example, the husband makes $40,000 a year, which means he should have $400,000 of income to replace to his family, which means for 10 years, his family won't have to worry about paying the bills because they're used to his money helping pay the bills. And when that income is all of a sudden gone, this is where financial devastation occurs. Same example for the wife. What if you have a significant other that doesn't work? Because I have that all the time. I have family back home in New Mexico, and the husband's off working in Texas in the oil fields, and the wife is at home with the kids. She's she's at home taking care of the kids. She still has a value to that household. Imagine that husband no longer with the wife. What would it cost to have babysitters, to pay for housekeepers, to pay for people to help him take care of those children? So even if you're not working, it doesn't mean that you don't have a value that you bring to your household. M is for mortgage. If you have a mortgage, would you want your mortgage to be paid off? Or do you want your home to be potentially sold because your family can no longer afford it? I've seen it happen. I've seen all these things I've seen happen where the family lost a home because they could no longer afford the mortgage because the breadwinner passed away. E in our example here is for education. If you have children, do you want to set aside money if you're gone too soon for them to have funds for education? If you don't have children, what about leaving a legacy to other family members, nieces, nephews, cousins, maybe to your tribal nation, maybe to your church, maybe to some nonprofit that you care about? So again, we're thinking bigger than just the $5 to $10, $15,000 to pay a funeral. We're thinking about using life insurance to leave your family financially stable. It's literally the lowest cost way that you can turn pennies into dollars, millions of dollars. As you can see here, the average person needs about $1 million in coverage. I know my dime calculation, the last time I did it was $3.5 million because I'm a mother of 3 children. It's a lot of responsibility. So again, if you don't do anything else, you need to seek proper protection, proper life insurance coverage. So moving on about life insurance, I do want to kind of talk a little bit more about the different types because all life insurance isn't the same. And I am a licensed life insurance agent. And I try to educate my clients because there is a big difference between different types of policies and they can serve different purposes. And unfortunately, depending on the insurance agent that you run into, they might try to mislead you or try to oversell you on something that you might not need. So one thing I want you to understand is that there's only two types of life insurance. It's temporary insurance, which is also known as term insurance. And then you have permanent insurance, which the only two types are whole life insurance and universal life. Most people, when they think life insurance, they say, oh, I have whole life insurance. And I have to correct them to say, you mean you have permanent insurance because that's one type of policy. So with term insurance, this actually works best for folks who need a lot in coverage. Let's say you need that $1 million, that $2 million in coverage. However, that can get pretty expensive. Term insurance is actually the most low cost, cheapest type of life insurance that you can buy for literally you're paying for the death benefit. It's for a set period of time. So most insurance companies, their term insurance policies could be anywhere from 10 years up to 30 years. It could be 1 year, 5 years. I would say on average, you could buy a plan for 10 years up to 30 years. And because you're paying for a set period of time, your costs are low. You're not paying a significant amount of money. And your dollar amount per month, you pay your premiums every single month, they're locked in for that 10 year, 20 year, whatever that term period is. But let's say, I'm in my 30s right now. I plan to live a long life. What if I buy a 30-year term policy? I'll be in my 60s. I think I'll still be alive. So what happens if I'm 60 years old or, 30, it'll be much older, 30 years later, and now my term insurance policy is up, 30 years is up. What happens is the policy itself actually does not cancel out. What happens is that the insurance company will say, okay, Shantae, now you're 67 years old. We're going to see what will it cost to insure you as a 67-year-old woman. That money will be so much more expensive. So long story short, term insurance is just for that. It's for a period of time. I do not recommend term insurance as a long-term need. It's to fulfill your insurable need right now for the moment in time. Because when you can afford a permanent policy, which I'll talk about next, then that's what you should have. Think of term insurance as kind of like car insurance. We have car insurance. We hope we don't have to use it. But if we use it, if something happens, we're thankful that it's there. Same thing with term insurance. It's literally pure insurance that you're paying for. Now, some companies now do offer some living benefits built into term insurance policies to where if you became critically, chronically, or terminally ill, for example, let's say you had a stroke or a heart attack, like something major health-wise, but it didn't kill you. They actually have some benefits built in where you can access a portion of your death benefit while you're alive so that you can take care of yourself while you recover, and then you'll maintain the policy. So some companies offer that, which is nice. So it's not just like pure insurance, because some folks think, well, I don't get anything out of it. At the end of the day, you want to have insurance versus not have it and need it. So let's talk about permanent insurance real quickly. So one thing with permanent insurance is that it is set up to last your entire lifetime. Most of these policies do go through age 120 because people are living well past age 100 now. And because of that, the costs are higher. So you're paying for insurance policy to be there when you get older, when you turn 90, 100, 120. The one thing with the permanent insurance is you have some flexibility with how you pay it. There's a minimum, there's a maximum. I think that one of the best features with permanent insurance is that this type of insurance actually accumulates or has the opportunity to accumulate some cash inside the policy. So it's a nice way to save money inside of a life insurance policy while also having your life insurance coverage. Your coverage pays out 100% of the time. As long as you pay into the policy and you're paying the right amount, your death benefit will absolutely pay out. So again, those are the two types. When I sit down with the client, sometimes we do just term insurance. Sometimes we do one of the permanent insurance. Sometimes we do a combination of both. I just want you to be educated about what's out there so that you can have, proper conversations with an insurance agent if you choose not to use me to help you with that. So moving along, step two, this is step two in building a financial foundation is managing debt. Now I'm going to kind of breeze through this section because I think we all know that we need to pay down our debt. I always tell folks like, look, let's start with figuring out what debts do you have. If you don't know, you can go to annualcreditreport.com and you can request a copy of your credit, what is it called? Your credit report, which should show any creditors, people that you owe, the balances that you owe, if you have anything in collections, if you have anything that's reported on your credit report. I tell people like, look, you should at least look at this thing at least once a year, especially with people's, identities being stolen. There's so much, garbage out there. Just check to make sure there's no errors, that everything's accurate. I'll tell you this, I'll give you one hint. If you have anything in collections, don't pay it. Don't waste your time. Do not, yes, this is me as a financial advisor telling you, do not pay anything in collections that's on your credit report. And the reason being is because unless you speak to the collection agency and they say, okay, we'll agree to, you can agree to pay down a certain amount to zero, unless they say in writing that they will remove that collection from your credit report, it makes no difference if it's on there and it has a $0 balance, a $5 balance, $5,000 balance. The simple fact that it's already listed as a collection account, there's no purpose in paying that off at all. No purpose whatsoever. You're better off trying to delete it, get it deleted, or have, again, to settle, negotiate, and have in writing that they'll remove it. If you pay it off to a zero balance and it's still on your credit report, it doesn't matter that it's a zero balance. It's still listed as a collection, something in collection, and it will still negatively impact your report. So if you want some more information about that, let me know. You know how to reach me. But I see so many folks, they get to me like, yeah, I just paid off my collection. And I'm like, oh my God, is it still on your report? Yeah, it didn't do anything. If it's still there, it hasn't changed your numbers. It did not increase your score at all. So one thing I tell folks is like, look, just get an idea of what's out there. For every debt you have, you should know how much is the balance. You should know what the monthly payment is, the interest rate, what is due. I have a big spreadsheet that I use for every debt that I have so that I can know what the numbers look like. And then one strategy that I tell folks is like, look, if you have multiple debts and your goal is to pay it down, pick one debt to pay down first. I think that's probably one of the biggest mistakes that I see a lot of folks make is they say, oh, well, I put an extra $25 here and an extra $50 there and an extra, $100 on this credit card. Put all of your extra money on one debt until it's paid off. Tackle it one card at a time. You can choose to start with the debt that has the highest balance first, or you can choose to take care of the debt that has the highest interest rate. We're going to talk about interest rate later in the presentation, but do not just throw extra money at all your debts all at the same time. Pay down one debt at a time. And then once that's paid off, now start moving all your extra money toward the next debt to pay off. That's going to be the quickest way that you'll get all of your debt paid off. And ultimately too, you want to just also think about, what am I getting in debt for? Am I, is it my spending habits? Am I buying things I don't need? Because you don't want to go through all this hard work to pay off everything and then you charge it back up later. So it's really a mental mindset and a physical mindset when it comes to our dollars. So step 3, I'm going to breeze through this section also because it's having an emergency fund. But I do have some caveats for it. Any financial professional will always tell you, you need an emergency fund. And it's so true. How many times do we see this past year where, well, let me tell you this, statistically, we know that the average American does not have $400 saved up to cover an emergency. That's a very hard, realistic statistic to just swallow in. I always tell folks like, look, an emergency fund is just having money available to pay for those things, those emergencies that's not on a credit card. Having money set aside so you don't have to charge up your credit cards. Because again, we're trying to get out of debt, not to get into more. I tell folks start simple because, when we hear, oh, you need 3 to 6 months of your income set aside, that's a lot of money. That could potentially be thousands and thousands of dollars depending on your income. But I don't want you to look at it as this big old giant goal that's going to be hard to accomplish. Make it small. Start with $500 first, then save $1,000, and then save 1 month of your income, and then continue to grow that money until I would say at least you have about 3 months of your income saved. And why do we say 3 to 6 months? Because what if you lose your job? Most folks are able to get reemployed, but to get a nice quality job comparable to what they had, it takes time. It takes time to go back out there, hunt and, interview, and you have bills to pay. That does not stop. So that's why we recommend to have that amount of time, that amount of money set aside. Now, one thing I'll tell you this, because a lot of folks, they save their emergency fund at the bank, and they typically put that money in the savings account at the bank. And I don't think there's too much of a problem with that. I just want to give you something else to consider, because what do our savings accounts give us in interest? I was very generous. I put on here on the slide 0.25%. But most savings accounts don't even give you that. Maybe one, maybe 0.1. Like, it's so little interest that you can accumulate. I want you to consider this. If you get to a point where you do save, a couple $1,000s, wouldn't you want that money to still keep growing? Like, yes, it's for emergencies, but emergencies don't happen every day for most people. They happen maybe every couple months. My belief is that if that money is set aside, that it should still grow. So do you want it earning little to no interest sitting in a savings account? Or why don't you consider alternatively investing that money? Yes, investing that money in the stock market in a low cost, conservative investment account. Conservative because it's not going to be risky. So that money you probably won't lose, it'll grow. But guess what? You probably still get some significant growth, maybe on average 4 to 6% interest. So a lot of my clients, I actually ran into a lot of clients this year who had like $30,000 sitting at the bank, $50,000, because they just didn't know where else to put it. So they had their emergency fund, they have more than enough money, but they had it sitting in an account earning little to no interest. And so then I came in and reinvested that money, and now they're earning 4, 5, 6% interest. They went from earning pennies every year to, multiple hundreds of dollars just because they changed where they were growing their money, and it was still growing for them. So something to consider. My 2 rules of having an emergency fund is, number one, the emergency fund is only for unexpected emergencies. It's not for shopping. It's not for sales. I know it's Christmas time. That's what the emergency fund is for. It's for those 2 a.m. My tire blew out on the side of the road. My refrigerator went out. A pipe busted in the house. That's what these emergencies are for. Rule number 2 is, and it's okay to use your emergency fund, because you might need to fix something. You might have a car repair. Just start refilling that money back. I have so many folks who say, oh, I spent all my money in my emergency fund because I had to replace, my hot water heater in the basement. That's great. You didn't have to charge it on a credit card. Now start replenishing your emergency fund until it gets full again. So that was step number 3. Now, these next 2 steps are what I'm going to spend the majority of our time together on, because to be honest, I like talking about steps 1, 2, and 3. They are absolutely foundational. And I tell folks, like, look, you need to get those things done first. You need to have proper life insurance. We need to have a plan in place for debt. And I need to see you start building up your emergency fund. Once you do those 3 things, then I'm going to talk to you about step 4, which is investing. This is the fun side of money. It's investing in the stock market, it's building your wealth. It's the sexy side of money, right? So that's what I want to spend a good majority of our conversation on today, because that's all people are thinking about now. Like, a lot of folks are curious, how can I invest my money in the stock market? What should I do? Where should I go with it? So let's just kind of take a moment to think back. When most people, I would say the average American, when they have money, when they start accumulating assets, they typically put their money into these 4 places. Number 1, they're taking advantage of, investment accounts through the job, which could be a 401k. Some of them are opening IRAs, which are individual retirement accounts on their own. I see a lot of folks trying to dibble and dabble in the stock market by having these phone apps, investment accounts on their phone apps like Robinhood or Acorns, and they're buying stocks and they're just picking, different things, and they're trying to grow money that way. A lot of folks are getting into real estate. They consider that investing, where they not only maybe have their own home, their primary home, maybe they're buying a second property or a multifamily property, and they're, collecting rental income. And that's a way to grow money. And then again, a lot of folks just take advantage of what's available at the bank, savings accounts that I mentioned, certificates of deposit, CDs. They're thinking that those are ways to grow their money. My question to anyone, wherever you save your money, where, just think, first of all, where I'm putting my money, am I happy with how my money is growing? Am I happy with how much I've saved? Am I happy with my investments that I've chosen? How they have actually performed, because if you're putting your money in these places, you should be getting statements to see how they're growing. And are you happy with their growth? I mean, do some of us even have a plan in place for any of this? Some of us don't. But I just kind of wanted to think about what the typical family does, and maybe some other things that you could consider to actually improve your finances. So a lot of folks, the number one question they ask me is, well, Shantae, how should I save? How should I invest my money? Well, it all depends. I have to sit down with you one-on-one and really go through a lot of scenarios, but some questions that I'll pose to you as you're listening to this presentation and think about, when it comes to investing and saving, there are so many factors and variables. I literally spend an hour conversation with clients before I even make a recommendation, because there's so many factors. Number one, what is your investment profile? What's your risk tolerance? Do you even like the stock market? Some people are like, I kind of know about it, but I really don't. I don't understand it. And you don't have to be an expert on that. I just want to get your idea of, is that something that you would even consider? Some folks are like, no, I don't want to touch the stock market. I don't want to lose anything. I don't want to take on that risk. So you really have to think about, how risky do you want to get when it comes to saving and investing your money? Because the general idea is, the riskier that you are with your investments, the higher the return. So it does equivalent. The riskier, the higher you get money, the higher you're expected to grow your money. Now, some folks come to me and they say, well, Shantae, I want to grow my money as much as possible, but I want to take on as little risk as possible. Guess what? Those are two complete strategies. You can't do both. You can't expect a high growth with little risk. And I'm not saying you have to put your money in a position where you could lose it all overnight. No, there is a correlation, and any good financial professional should go through some questionnaires and to help you figure out what's a good comfort zone for you. That's what I talk with a lot of my clients. Let's determine your comfort zone when it comes to investing. The second question that I'm going to ask you is, what is your time horizon? Do we have a year to invest this money? Do we have 10 years, 20 years? Because believe it or not, depending on how much time you have, it does make a difference on what investments make sense for you. Because some investments will lock your money up for a period of time. It'll be growing and it'll be investing, but you can't touch it or else you'll be penalized. Some investments work well for the shorter term. Others work well for the longer term. So the time horizon really does matter. Another question that I always ask folks is, when do you need access to this money? Again, do you need this money in a year? Do we have 10 years? It really does make a big difference, because I don't want to recommend something to you where your money will be inaccessible. And then the last thing that a lot of people don't think about is, when are we going to pay taxes on our money? I don't care who you are on this webinar, or if you're watching the replay, we all have the same uncle, Uncle Sam, the IRS, the Internal Revenue Service. And no matter where you save or invest your money, our favorite uncle wants a piece of it. All of any account that has a dollar attached to it, a value attached to it, guess who makes the rules for it? the IRS. So you should know that there are ways to avoid paying taxes or to pay taxes later, or how can we pay a low amount in taxes? And I think my next slide will talk about that. So again, when you try to think about where should I save, how much should I save, these are all questions that we have to answer before we figure out, okay, what accounts should I open and what should I invest in? So that's what I want to talk about is investment options or investment accounts, because again, when you're trying to grow your money, you want to be strategic, very, very strategic. We don't just open any type of investment account and think that that's the best. No, there are different accounts that make sense and serve different purposes for different people. Now, with me as a professional, when I look at investing money for my clients, I actually look at it from a tax perspective first, because at the end of the day, I want to know how much money will I be able to keep? How much money will you be able to keep as an investor? Because again, our favorite uncle always wants a cut of it. So what you should know is that when you open any type of account, there's three different buckets from tax purposes. You have your tax now bucket, and that means just that every single year you are taxed on any growth, any savings, any interest, any dividends that you earn. So any earnings, any interest, any dividends that you earn on those accounts, you pay taxes on that money every single year. Now, you pay capital gains taxes, which is only at a 15% rate. That's lower than any other investment taxes that you'll pay. But again, just know you'll pay taxes. But why would people put their money in a tax now bucket knowing every single year that they'll pay taxes? Well, if you look at these accounts, it's because they're easy to get to. Checking and savings accounts, you can go to an ATM and pull your money out. CDs or certificates of deposit, for the most part, they're pretty easy to get to. They might have a surrender fee on it, but you can cash them out. Brokerage accounts. A brokerage account is actually a type of investment account. Any money's in a brokerage account, all you have to do is sell off your investment and you'll have that money available to you. So even though you pay taxes every single year, your capital gains taxes, the money is easily accessible. And that's why someone will put money there. So the tax later bucket here in the middle, these are typically retirement accounts set for age 59 and a half and later. That's generally the IRS's age for retirement, 59 and a half. After you turn 59 and a half, you can pull your money out. But as you see the word tax later. So what that means is that you are taxed later in retirement. But while that money is growing and while it's investing, you don't pay any taxes. So that's a really great thing to take advantage of because that money that's going to keep growing and compounding. However, in retirement, when you need it the most, that's when you pay your taxes. The problem with that is, do we know what tax rates will be in the future? We don't know. Like I said, I'm in my 30s, so I have a long way before I retire or get to 59 and a half. I don't know what the tax rates will be 20 years from now. But when I look at what the government is doing and how much debt they've accumulated, what's the government's way to solve a lot of their problems? They increase taxes. So again, I'm not saying these are bad places to save. You should just know that. So examples of these accounts would be, again, workplace retirement accounts, 401ks, 403bs, 457 plans, deferred compensation plans, traditional IRAs, SEP IRAs are for business owners, annuities. If you are lucky enough to have a pension from your job, your pension is actually taxed. When you start collecting it, they take taxes out. So again, these are generally retirement accounts. Not all of them are, but most of them are. And again, your benefit is you don't pay taxes now while it's growing and investing, but you do pay taxes later in retirement at whatever that tax rate will be. We don't know. It's like writing a blank check to the government. Then the last bucket is your tax advantage bucket. So these strategies, these are the type of accounts you can save and invest money for certain purposes. While that money is growing and investing and earning, you don't pay taxes. And as long as you pull the money out according to the rules of each account, you don't pay taxes. So it's a tax-free way to save and grow money and pull it out. Now, I just put down 4. There's more. Of course, there's more options than what I'm putting out here, but these are the most popular. A Roth IRA, again, is another retirement account. But again, you can save and invest for retirement and pull out your money in retirement after age 59 and a half. Cash value life insurance. This is actually what I was talking about earlier. It's a type of permanent policy. Remember, I said some money can accumulate in cash. That cash that grows inside the life insurance policy, you can actually pull it out at any time as long as it's available. There's, the insurance company has some ways to make it available to you, and you don't have to pay taxes. So I actually use this strategy for my kids because I'm saving and investing money for my children so that and when they get older, they'll have some cash that's accumulated inside the life insurance policy. There's no certain age attached to it. Again, as long as the money's available, they can pull it out and they could pull it out for any purpose. So it's a really unique strategy. I have a webinar just on that strategy alone. A 529 education savings plan. This is saving and investing money for education. As long as you use it to pay for tuition, books, school fees, you don't pay taxes on that money while it was invested in growing. And then a health savings account. Some workplaces offer these where you can save and invest money. And as long as you pull it out for health needs and health expenses, you don't pay taxes. So I'm not saying that either any bucket is better than the other. I think you should have money in all three buckets. But I think it's important to know from a tax perspective what money you'll be able to keep and what money you have to write over to the IRS. So while we're talking about growing, what I just talked about were just the type of accounts you can open, but what can you actually invest in inside those accounts? Because the investment is what's going to make that money grow inside the account. So I just always want to start with what grows and what doesn't grow. I want to be very straightforward with this. Like things that generally don't grow, anything at the bank really won't grow. Checking accounts, savings accounts, money market accounts, CDs, those things don't grow. You might get 1% interest, 1%, which means if you had $100 saved, you'll earn $1. That's not great growth at all. The government tries to offer investments, government bonds and bills and notes. Like you might see a lot of savings bonds. Those things don't grow either. They actually just keep up the value, which means keeping up with inflation, but they generally don't grow. So for example, when I was 10 years old, my father got me and my sister, I think it was a $50 savings bond. No, it was $100. And we were like, oh, $100. But it was a 30-year bond, which means we can't cash it in until 30 years later. And all it will be is $100 30 years later. It didn't grow in value. It won't grow in value. All it does is it keeps the value of that, that bond the same 30 years from now. So let's talk about things that do grow. Anything tied to the stock market, basically stocks, bonds, mutual funds, ETFs, which are exchange traded funds, UITs, which are unit investment trusts. UITs are probably my most favorite investment right now. I love them. Index and variable insurance products. These are all things that directly invest in the stock market or tied to the stock market, meaning they look at what the stock market does. And if the market goes up, then your account goes up. So these are things that generally do grow. Now, what makes sense for you? Again, that really depends on your riskiness, your risk level, how we create your portfolio and how do we put all these things together are based on the type of account you open, how long you have to invest and save that money, but also your riskiness, because some investments are a little bit more risky than others. But here's the general rule of thumb. If you don't write anything down, write this down. If you're saving and investing your money and you're not earning at least 3% interest or more, you are not keeping up with inflation. And inflation is actually a big topic right now. Inflation is the cost of goods increasing every year. The cost of gas, the cost of eggs and postage stamps. Basically, our cost of living increases every single year. Inflation is high. Right now, it's a little higher, because of all this inflated money that the government put into the market, into the economy. But over the last 10, 20 years, inflation increases about 3% every year, which means if your savings and investments are not increasing by 3%, you are actually losing money because you're not even keeping up. Your purchase power, your value of your money is not even keeping up with inflation. So 3%, magic number, at least earn more than 3%. And if you're not getting that, then we need to have a conversation. So I want to talk about my favorite financial concept. I actually don't talk about it as much, and I should. It's my favorite financial concept called the Rule of 72. And I want to talk about this because it directly applies to, again, to our savings, to our investing. And all the Rule of 72 is, it's a mental math shortcut to let you know how long it will take your money to double if you continue to save it or invest it in any particular place. So the mental math shortcut is you should be earning interest, right? And wherever you save your money, take that interest rate, divide it into 72, and that will tell you how many years it will take for your money to double. So if you look at some examples here, if you were investing, again, in the bank, you might be earning 1% if you're lucky. 72 divided by 1 means that your money will double in 72 years if you keep it in the bank. As you can see, the higher the interest rate that you earn, the quicker your money will double. 72 divided by 9 is 8, which means every 8 years your money will double. What if you were investing and you found, on average, you were earning 12% growth in your accounts? 72 divided by 12 is 6, which means every 6 years your money would double. So the higher the interest, the fewer years it takes for your money to double. Why is this important? Because the whole purpose of you saving and investing is so that your money can grow. You want to get as many doubles in your lifetime as possible when it comes to your wealth. And yes, there are absolutely places where you can earn 12% interest or more. And again, that's where working with a professional like myself, we can help you get these higher interest rates versus what's available at the bank or even at your job. So why is this important? Because the national average interest rate for savings account, it's not even 1%, it's 0.09%. And this is where most people keep their money, sitting in a savings bank account. 72 divided by 0.09 is 800 years. You will never see your money double and grow. So again, I hope you understand, let's think outside the bank. Let's think about how can we really grow our money. Now, up until this point, I'm talking about growing our money, accumulating wealth, but the rule of 72 can also work against you. And that's when it comes to your debt, because doesn't your debt also have interest? Don't you, when you take out a loan, aren't you repaying an interest rate? When you have a credit card, you're repaying a certain amount of interest on that money that you charged up. The average interest rate on credit cards is a little over 17, it's actually 18%. Right now. 72 divided by 17 is 4.2 years, which means if you had, let's say you had a credit card balance of $10,000 and it's at 17% interest, and that's the average, which means a lot of people are way higher than 17% interest. Your $10,000 debt will double every 4 years. But what do the credit card companies tell us? Oh, just pay the minimum balance. Just pay this $25 a month. Just pay this $35 a month, because the credit card companies are not stupid. They know how to use the rule of 72 for their advantage by having you pay little to no amount towards their debt, because they know it will double. That's why I have so many people who come to me and they're like, Shantae, I'm trying to pay off my debt. I'm paying extra, but it doesn't feel like it's going anywhere. It's because the rule of 72 is really working against you. That's why it's so important that you really tackle that debt one card at a time, one debt at a time. So I love the rule of 72. When I first saw this, and trust me, I've been going to school for a long time. This is not something I learned when I was getting my MBA. It was not something I learned when I got my accounting degree. This is a topic, a concept that I think every 18-year-old needs to learn when they're signing their student loan paperwork or they're signing up for their first credit card. The rule of 72 is so important. We want to make the rule of 72 work for you, not against you. So now, as I end up on the last step of building your financial foundation, is actually preserving your estate. Thinking about estate planning. I want you to think, if you went through all 5 of these steps, all 4 up until now, you got your life insurance in place, you're paying down your debt, you have your emergency fund, you set up your investment accounts. The worst thing that you can do is not protect your assets that you started to create for yourself by preserving your estate. And this is when you actually get legal documents in place that dictate what happens to your assets if something happens to you while you're alive, but then also and death as well. Now, I want to go through these 4 documents because I believe no matter what, these are the 4 main documents that anyone should have. The first being a will. A will is a legal piece of paper that dictates a couple of things, very important. Dictates, number one, if you have any minor children, it will name a guardian for those minor children. Because if you don't name a guardian, a judge will try to figure that out for you. And I don't want any judge trying to figure out who's going to take care of my 3 kids. But a will also dictate who gets your assets. You basically write your wishes of who you would like to take over your assets. So you would say, oh, I want my nephew to receive my Camaro. I want my daughter to receive my jewelry. I want so-and-so to receive my furniture. You cannot transfer property like a house, anything with a title or deed by will. A lot of people think they can. You cannot. This is only a will is only literally a suggestion to the courts to say who gets what. Now, and this is only if you go through probate. Most people don't really have a lot of assets to get to that point. But if anything, you want to have something in writing that says these desires. You'll also name an executor of your estate. This is the person who can handle your affairs after you passed away. I had a family last year I was working with. Their mother passed. It was a brother and sister. Their mother passed away. And she had no will, nothing in writing, which a lot of people died, unfortunately, without these documents. And they were trying to transfer the mortgage on her house to the son. He had to go to a court to say, hey, I'm the son, I'm her next of kin, she's not married, I should be able to take over the mortgage, I'm willing to take over the mortgage. The court put him through hell to get that authority to be able to get that piece of paper, because the banks just need a piece of paper that says, yeah, you can handle those affairs. It took him forever to get that. But if she had a will in place, at minimum, it would have made that process smoother. One thing you should also know about a will is that it can be challenged in courts. Just because you have it in writing doesn't mean that it has to be followed along. If you ever heard of Aretha Franklin, the hip hop soul, queen of soul, who passed away, I think in 2018, 2019, her estate is still in court right now because they found 4 wills for her, and the judge trying to figure out what's the most accurate document. So again, it's important to at least have it, but it only states who should get some of your assets. A house will not transfer by will. And again, it can be challenged. It can be challenged in court. Somebody could say, well, this is Shantae's will. And I'm like, no, this is Shantae's will. It can get very, very messy, but at minimum, get this. Financial power of attorneys are super important because this is when you have a legal document that will authorize someone who can handle your financial affairs while you are still alive. They do have power of attorneys that can go into effect after you pass away. Those are called durable power of attorneys, but your general power of attorney says, you know what if I'm in the hospital? What if I have Alzheimer's? Who can pay my bills? Who can get money out of my bank account? Who can take care of my taxes? That would be an important document to have someone authorized to do that. I can't tell you how many random people who have contacted me and told me horror stories about their parents who had a new wife who moved them across the United States, and now they're in a mental home and they signed something over. And I'm like, yikes. And that person now has dementia and they're like, they can't reach them. When somebody is no longer in their right mind and they can't sign their name, they don't know what they're signing, no judge, no legal anybody will recognize that power of attorney. You can only sign these documents when you know what you're writing, when you know what you're signing. If somebody's in a coma, you can't make them scribble their name on a piece of paper. It won't be effective because you need a notary to make these legal documents. A notary has to say, okay, this person came before me. They were in their legal mind. They presented their ID and I witnessed them, put their signature on these papers. If you're a parent, again, I get these horror stories. If your parent is incapacitated and they can't make those decisions, you can't now come in and say, oh, can we get a power of attorney? Unfortunately, it's too late at that point. You might have to go through some more extreme measures. Similar to a power of attorney for finances is your advanced healthcare directive. You can name one for your medical needs as well. Your healthcare needs a power of attorney. And then your healthcare directive, your living will, This basically identifies a person who can make healthcare decisions on your behalf, or you can put in writing what type of medical treatments that you wish to receive when you can't make that choice for you. So again, I had another story where two sisters came to me there and their mother was in the hospital. It was a life or death situation. The doctor was like, look, we could, put that thing in her throat. I think it's a trachea or something. It might save her, or we could just let her go and she'll pass away. These two sisters fought over what decision to make for their mother. Have their mother have put those wishes in writing, the doctors would at least have known what she desired. I have another couple, a husband and wife. I just finished this with them. The husband's like, look, if something happens to me and I'm a vegetable, just pull the plugs. I don't want to live life that way. I won't even know it anyway. And the wife was like, no, if that happens to me and I'm a vegetable, I believe a cure might come along, keep me plugged up. Those are wishes that you could put in writing so that your family and your healthcare providers will know what to do for those things. And then you can have a HIPAA release that just allows someone to have access to your records and access to your information. So again, these are like the 4 basic documents that you can get. I have a program that I work with a company who can help you prepare these things if you're interested. However, the one thing that I recommend that trumps all of this is actually a trust. A trust, again, is a legal entity that's established through paperwork that indicates everything regarding your health, your assets, how it should be distributed, who gets what property should transfer to who. A trust will dictate all of this for you, and it's completely private and it cannot be challenged. Whatever is written in that trust goes. So one thing to understand about a trust, 2 things rather. When you establish a trust, it's just a piece of paper until you give ownership, until that trust owns property. So you can create a trust and you can get it notarized and you can have all your instructions and wishes written in it, but it doesn't mean anything unless that trust owns some type of property. So a trust works best when it owns your home, your real estate, your property, your investment accounts. It can own your cars. It can own its own. It can have its own bank accounts. Anything that trust owns, meaning it's the owner of that asset, will take place under the direction of the instructions of the trust. So, for example, if you have a home, let's do 2 scenarios. Let's say, Shantae, I own a house, right? I own a house. If I pass away, the only way that I can transfer that house to my children is to do some type of a title or deed, and hope that, that doesn't get caught up in probate court. But if my trust owns my house, I'm still the beneficiary of my trust. My trust owns my house. My trust will say, oh, your house will transfer over to your children. And then there's a process that will happen automatically for that to be done, to go through the recorder of your court to have that transfer of property. So you have to have your trust own the property for it to become into effect. Otherwise, it's just like an empty box. You have to put something in the box that the trust owns. And the trust will have its own tax ID. It will have its own instructions. You can dictate anything that you want to happen with your money in this trust. You could say, you know what? I want to, if my child graduates, high school, they get X amount of dollars. If they get married and have a child, they get X amount of dollars. If they go to, whatever, you can make up so many scenarios about how to distribute your wealth and transfer your assets. Again, completely private. It avoids probate. Obviously, an attorney would help you with this. And again, I have the resources to help you. But a trust, if you really, really want to make sure everything is sealed tight, no one can interfere with your assets, you want to establish a trust. So I think that's the last of my slides. Yeah. So those were my quick 5 steps. Don't leave just yet. I got a couple of resources for you. All I just want to say is that if you go through these 5 steps, I promise you, your finances will be so solid. It will be so secure because it will last. If you lose a job, you'll be fine. If there's government laws that changes, you'll be fine.